Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Crude continues to surprise to the upside, while the Canadian dollar has not taken advantage of oil's advance. The U.S. job picture is bright, while Canada's is not. He also has a special offer for our listeners. Kaiser Watch's John Kaiser wades in on the junior miner scene and tells us how he expects that sector to perform this year and what potential conflicts involving Russia and China could do to the metals market. Publisher of the realestatetiming.com newsletter, Robert Campbell, reports in from San Diego and comments on inflation, interest rates, government debt, and U.S. real estate. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, you're willing to share your immense knowledge in the markets and what might happen. You have a special listener offer for us.
Yeah, what we're doing here is 25% off for new annual subscriptions. We're going to make that good through the 13th, so, through 2 weekends here, and give people the opportunity to join in on us with some of what have been some pretty good turning points. And Bob's work is really designed to look at the big picture, and he puts out a weekly commentary regarding just everything from the currencies to stocks to bonds to precious metals, and along with an editorial. And then for my work, we're looking to pin it down to some of the technical work that I do, where we look for key reversal points. And, in any given year, there are a few big ones that jump out and a lot of minor ones. And, a week ago, we had just a great combination of signals on the 24th, 25th of January, where, the markets had just absolutely fallen out of bed. And so we got capitulation readings in our daily charts. We got different signals over on the weeklies. We had a signal on the VIX, the volatility index, that we hadn't seen in 2 years. So the probability of a bounce was just exceptional. So S&P and the Dow, which had been the two strong items, both recovered 60% of their losses. And anybody who's taking option trades on there, depending upon their timing, they were up anywhere between 70 and 300% on that move when it got up into the first resistance area. So that's the type of thing that, I look for, short-term opportunities, and Bob takes care of the bigger picture.
Taking a look at what's going on with the markets right now, how would you sum up the year so far? Because we did see a number of big red letter days again in the past week.
Oh yeah, I'm a broken clock here. I really think this is very much like the .com era of 2000, and somewhat like the post-housing issues back in 2007, 2008. So what you've had going into the November high, the highly leveraged companies that you saw in things like the NASDAQ and the Russell 2000, they made their highs and have been eroding ever since then. Whereas the blue chipper ones, the S&P, the Dow, have managed to work their way higher. And this is exactly what we saw in the first half of 2000, when companies with questionable earnings and lack of dividends finally ran out of their momentum play, and the astute longer-term investors went out and picked up some pretty good bargains where you could actually get a dividend and felt fairly secure. So, if we look at the way the market finished off this week, you've had the S&P and the Dow getting back reasonably close to the highs that they had midweek. But you take a look at the over on the NASDAQ and the Russell, big capitulation lows, but really just had dead cat bounces up to their 20-day moving averages. And in downtrends, that's what you're going to expect. Poor rallies, small overbought signals, things like the relative strength index, instead of getting up into high numbers like it's 70 or 80 on a scale of 0 to 100, they'll only get up to 40, maybe 50 on the bounces, and then they head back down again. And so that's really what I see going forward here. This is a market where, there's the good, the bad, and the very ugly. And on the really good side of it has been the oil market, which, when it broke out back in the mid-70s, my target was up at 103, and here we sit at $92 and change, and the oil stocks coming along pretty well. They paused a little bit right at the end of this week, and I would think if the oil market does manage to push up through 100, I'll get some pretty good sell signals as far as the stocks are concerned, because there are leading indicators that I've got on them right now that would result in a sale if we got a bit more of an exponential move here.
What's going on with the U.S. and Canadian dollars?
From a fundamental perspective, the U.S. job numbers are just 4 times what they were expecting, 467,000 versus an estimate of 125,000. And on the other side of the coin, you got the Canadian economy with down 200,000 on an estimate of 110,000. So things in the U.S. side looking much better. Canadian side very questionable. And when you look at what the Canadian dollar has not done in the last couple of weeks here, with the strength that we've been seeing in commodities, with crude oil where it is, and you take a look at things like the Deutsche Bank Commodity Index trading at multi-year highs as of Friday, and yet the Canadian dollar is just waning here. A poor week, 78.31, down from 79 midweek, and down from 80 and a quarter in the middle of last month. So, Canadian, I guess we got more problems than we've got good things going on.
What's happening with gold?
Well, some good oversold readings on silver and gold a week ago, just on the daily charts. And when we get simultaneous signals like that, you typically will see a period of buoyancy that will last 2 to 4 weeks. Not necessarily, big movement on the upside, but enough to just hold them in reasonably well. So that's the type of thing we've seen. There was a bit of a deep correction in gold on Thursday, but managed to bounce back on Friday. From a timing perspective, the middle of February through the middle of March is where you tend to see important highs as far as gold is concerned. I think dating back for 25 years, it's pretty much, all but one of those years saw gold form a high or just a pause in a downtrend and then continue back down again. So could have some buoyancy for maybe another week or two, but I'm really leery about what happens as we get into March. I know there are a number of people out there looking at the Fed and the Fed funds rate and thinking that once this interest rate move starts on the upside, at least once the Fed starts to catch up with what's really going on out there, that gold will just spring way to life. Well, that might happen, but as far as I can see, that's just not quite in the cards as of yet.
What's happening on the cryptocurrency front? Ross, what's happening on the cryptocurrency front?
Well, like a lot of these markets, big capitulations on the downside back in the January 23rd to 24th range. You had Bitcoin at 35,000. And for us, that's capitulation with high volume and big panic selling in there, both on the daily and on the weekly charts. So the recovery's been pretty decent right now, up at 41,000. I really don't see that there's a huge potential in here. I think you're probably looking at something in the mid-40s, but this a decent trade off the bottom when you think about it. It's up 6,000 off the low, and for short-term traders, that's great. If you're a long-term investor, who knows? It depends upon what your time frame is.
Ross, thank you so much for the update.
Welcome, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at ChartsByRoss. Coming up next, John Kaiser on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Kaiser, who has a new show out called Kaiser Watch. John, thank you so much for being on This Week in Money.
Jim, it's a pleasure to be on This Week in Money.
Now, of course, some people may have wondered what happened to Discovery Watch that you did on How Street, but you have a new show called Kaiser Watch. Where can people catch that program?
The best place is to go to my website, KaiserResearch.com. That's where you'll find a link going to the Kaiser Watch archive and the links to all the other shows themselves. And I publish a daily, or when I do a Kaiser Watch show, I publish a blog item which breaks down the questions, allows you to pick and choose. And something different from Discovery Watch, now that I run the whole thing, I'm able to include graphics to help illustrate some of the stuff that's talked about. For podcast people, that's of course of no use, but they can always go to the website and see the graphics associated with the Kaiser Watch interview.
How are the junior markets looking so far this year?
Well, the resource juniors have done better than the non-resource juniors. I track them through the TSX Venture Exchange. I know which ones are all the resource listings, and what I look at is the relative traded value. The last quarter of 2021 was, of course, very miserable for the resource juniors. Almost across the board, they had a ski slope type chart pattern. There was an awful, a lot of window dressing in those that were institutionally held as they sold off at year end to get rid of the losers. And of course, individuals were sitting on tax losses, and they made money in the first quarter selling stocks. That's when the resource juniors were strong, but they were selling off losers in December to get, just to offset some of those capital gains that they would otherwise have to pay. So it was a pretty dreary finish, yet it was a strong quarter anyways in terms of value traded. They picked up. The resource juniors gained the upper hand, trading more than 50% of the total traded value. That's very different from most of the year when the non-resource listings dominated. The resource listings were only 25 to 35% of traded value. And in January, with the volatility in the general markets and the shift away from tech spec or spec tech and the assumption of super growth in the future in an environment of low interest rates, That has changed. We now expect a normalization of interest rates. Inflation is persistent. It's not as transitory as everybody expected. So that there has been a secular shift away from sort of disruptive growth stocks into more traditional value stocks. And that's a good thing for the resource sector, because although interest in resource juniors has been weak since April last year, the resource stocks, they're not like these infinite growth type companies. They are a more conservative type of stock, and commodity prices have stayed high. The major producers have not really posted big gains, but they also haven't really lost prices, lost their levels that they stabilized at after the initial run up in late 2020. The resource juniors, they've had a modest January effect, a very good one relative to non-resource listings in that they have sort of lifted off their year-end bottoms, but there is not yet a roaring interest in this sector. Everything is in a state of limbo, waiting to see, is there going to be a big general market pullback? And I'm quite enthusiastic about the resource juniors because I see this problem that Putin has created for himself with massing his troops on the border of Ukraine and making impossible demands of the West about the United States retreating back to America and NATO just backing off and allowing Russia to stretch its influence back into the former Soviet Empire. I think this situation is going to come to a head sometime this year, and it will have an impact on gold, and it will have an impact on metal prices because it will be very disruptive to everybody's assumptions for raw material supply, which are already stressed because of the supply chain problems that arose from the COVID pandemic.
How are the junior miners doing compared to the price of gold?
Well, the problem with the resource juniors is that it's not the level of the gold price that seems to drive investors. It's the rate of change in the price of gold. And gold's doing fine. It's around $1,800. It did not retreat back to that $1,200, $1,300 level that it was in early 2020 before the COVID pandemic hit. But since peaking in September of 2020, interest in the gold juniors has been relatively muted. They've tracked sideways. And I think the interest in so-called optionality plays, there's a disconnect in the market. The market doesn't believe that gold's going to go higher in real price terms until it does. And it still hasn't really come to terms with the reality that the current gold price is a substantially higher real price than it was before. And the way to look at it is I always go back to, okay, after gold was released from its $35 prison in 1972, it stabilized at about $400 in 1980. And if you assume that, okay, that was the adjustment to all the historical accumulated inflation, if you inflation adjust that forward, that's $1,420 today. And yet the gold prices has averaged $1,815 so far this year. It's around $1,803 right now. So that's a significant 27% real gain in the price of gold. So this lowers the bar for what counts as an exploration success. And I'm pretty much focused on juniors that are involved in so-called district rethinks that are taking old mineralized systems, ones that maybe used to be mines or ones that never quite became mines, bringing fresh ideas to them, new exploration methodologies, deeper looking geophysics, more sophisticated ideas about alteration zonation patterns, and of course the power of computation, all the data they can now feed into computers and look at what's going on from multiple perspectives. We're entering a new era of what I call the rethink of existing systems, and we are seeing a retreat to safer jurisdictions such as Australia, Canada, the United States, maybe Mexico. Africa's becoming a terrible place to be because the civil strife that's showing up in these areas. And there's also this backdrop of globalization coming apart at the seams, and what I call the future carve-up of the world between China, Russian, and American spheres of influence, which are going to make these trading zones possibly not interconnected the way they are today, which really creates a current pressure to start thinking about the medium to long term. Where do you get your raw materials from? And of course, in this scenario where the United States is not the top hegemon anymore, but the power is balanced between similarly strong rivals, the U.S. dollar will no longer be the supreme world reserve currency, and the transition is not going to be mediated by Bitcoin and other cryptocurrency. It's going to be mediated by gold. So I expect gold to regain favor with the market. It'll lose interest in the whole Bitcoin, which has shown itself to be as volatile as the general markets. And I think the future is looking good for the gold juniors. The only issue is what is going to be the kickoff that gets investors coming back into the sector. And it does require fundamental outcome gambling mentality. I think the momentum gambling mentality of all these newly minted retail investors, I think that's going to run into some serious problems. And we're going to lose a lot of these investors that opened accounts in 2020 when they had nothing better to do during the COVID lockdowns. But it only takes a fraction of those to realize that the resource junior sector has a way where you can make outsized gains, but not by day trading, wasting all your time staring at numbers going up and down. So I'm bullish on the sector. It hasn't been punished as much as non-resource juniors, and I think it's looking good. And it was a pretty good financing window in the last quarter, even though stocks were selling off. A lot of money was still raised for juniors heading into 2022.
How are the junior miners doing compared to the price of silver?
Well, the price of silver is sort of stable in this $20 to $25 range, and most people who understand how things work see silver as an important industrial metal as opposed to a precious metal that's supposed to be money. Most of the silver that exists is fabricated into doing something useful, where only a tiny fraction of the above-ground gold stock is doing anything useful. The gold stock is being used as a hedge against uncertainty, long-term uncertainty, whereas silver is being used in all kinds of industrial processes. And when silver goes up, the general market doesn't respond. The silver stocks, the companies that have minted themselves as primary silver juniors, they track the volatility in the silver price, but that's a relatively small segment of the junior sector. I like the silver price where it is. That's up considerably from where it was before. So again, looking at juniors that are looking for exploring or reinvestigating old systems with gold and silver in it, this is going to be a thing where, hey, silver price is great. Let's wait and see when people start getting interested in the idea, exploration results are changing the average grade of the system and the size of it, and hey, we may have a mine on our hands. That's the way I look at silver right now. So price of silver doesn't really affect the market in general, and usually silver is a byproduct anyways from most deposits, such as copper systems or gold systems. So whether it's up or down 20% doesn't really matter in the grand scheme of things for these resource juniors.
How are the copper juniors doing?
Well, the copper price has held up very well, and the big copper miners, Freeport looked like it was dead in the water at the start of 2020, and it's one of the biggest gainers out in the resource sector, and it has held its 500% gains. Many of its operations are based in the United States. A lot of them are SXEW operations, and there's new technologies emerging which allow companies like Freeport to look at the raffinate that gets pumped back onto the heap leach pile and see if they can strip out some of the critical metals that are on America's critical metals list. if we do see the Russia-Ukraine situation spin out of control, that doesn't really affect copper because copper comes from many parts of the world, and neither China nor Russia are major suppliers of copper, but a lot of other metals come from these parts of the world, and their supply could end up being disrupted if Russia does decide to invade the Ukraine and then just sets the dominoes falling all over the place with who knows what sorts of consequences. The juniors themselves that have advanced copper plays, they haven't, again, there was this big disconnect last year. From April onwards, all the hype about the electric vehicle future, the clean energy transformation, it all seemed to fizzle, and the copper juniors have been relatively stable, and they respond to exploration results, but they haven't really been going up because people are enthusiastic about copper. Copper here at the sort of 425, 460 per pound level, that's the highest it's been. That's a significant real price increase. And the energy transformation, the grid transformation, all of these things have to happen, whether or not you're using renewable energy. So long-term demand for copper will rise. So again, going back to these old districts, rethinking them, and even doing something more gutsy, like coming up with theories of drilling through barren or gravel cover, looking for blind deposits that aren't geochemically evident at surface. That's sort of going to be an emerging grassroots game. But again, going back to all these existing copper systems, and British Columbia is a great place for that. Did the previous explorers really understand what it's all about? And with a lot of these porphyry deposit types, grade seems to improve at depths. And with higher real copper prices and the block caving activity that is possible, underground mining of higher grade copper roots of these deposits. I mean, we saw Newcrest take a major stake in Red Chris. We saw Newmont buy out GT Gold, which is a copper gold type system. There's strong interest in copper projects, and with gold, you never know. Perhaps Putin goes back home and decides that we're just going to be a rich country producing lots of raw materials, have great relationships with everybody. We're not going to mess with Europe in terms of manipulating the natural gas supply. We're just going to grow and be a major serious force, and China decides to relax a bit and stop trying to turn itself into a new control freak hermit nation. We could see peace and harmony driving the price of gold back down. But in terms of copper demand, unless the world goes into a major depression and perhaps even a pandemic that is truly lethal and reduces the population, we're going to see strong copper future, and rethinking systems for their copper potential, that's going to be a game for the juniors that will persist.
How are the battery metals juniors doing?
Well, lithium clearly has emerged as a superstar. In 2020, it was down there in that sort of $2 to $3 a pound for lithium carbonate after being at the $12, $13 per pound range in 2016 when we had the first lithium boom. There were a whole group of deposits, the pegmatite deposits, hard rock deposits in Australia that came on stream. They were all sort of questionable at the time and became even more questionable when the price of lithium carbonate tanked. But the big surprise at the end of 2020, despite Trump's endless bluster about how fossil fuels are great, climate change is a hoax, science is garbage, the car industry continued to develop its electric vehicle technology, and whether or not there's any relationship between climate change and fossil fuel combustion, there is a trend in place towards clean energy and electricity as the fuel that powers cars. In China itself, its oil import dependency is a huge Achilles heel for that nation with its grand ambitions. So it needs to wean itself off of gasoline as the basis for its car industry. It's transforming its vehicle sector. So the batteries, we're not sure what technologies will eventually rule. I think the current technologies all have one or more thing that's still wrong with them, but there's so much money going into battery research right now that by 2030, when I think we're ready for the electric vehicle demand to break out beyond the sort of elite demand that it's enjoying right now, there'll be a new battery technology for sure, and that everybody will adopt. It'll become mainstream. Lithium will be part of it. Nickel will probably be part of it. What other metals, we don't know. Metals like cobalt, because of the unreliable supply from sketchy places like the Congo, everybody wants to get rid of it. But who knows what the configuration of the technology will be. But there's been several billion-dollar buyouts in the lithium sector involving juniors, particularly ones that have the brine operations in Chile and Argentina. So that sector with lithium has been strong. Nickel is strong. There's a lot of interest in juniors that are going to be, are advancing major nickel deposits, especially ones where they aren't just making a nickel concentrate that goes to the smelter and ends up in a warehouse that still has to be converted back to nickel sulfate. Projects where from their feedstock you can make nickel sulfate directly. That's going to be of particular interest to the car makers, maybe not directly, but perhaps indirectly. The Teslas, the Volkswagens, the GMs, the Fords, they're all going to be looking at clean sources of nickel sulfate where they can verify that, yes, this is clean, this does not come from Russia's nasty Norilsk operation through some indirect manner. Interest in nickel is strong because they're, again, it comes from multiple parts of the world, so we don't have a security of supply crunch from physical, geopolitical disruption, but its linkage to stainless steel demand and this new emerging battery demand, that creates a very favorable outlook for the nickel juniors.
How are the uranium juniors doing?
Well, uranium juniors since Fukushima in 2011 have really suffered because the price of uranium ended up at one point even below $20 per pound. And the world really needs, all the producers really need $60 plus per pound. But the problem was the utilities, they stockpiled this material, and then suddenly Japan was no longer shut down all its nuclear power plants, so it started getting rid of its stockpiles. And Germany, and this is one of the saddest things out there in the whole clean energy space, is the Germans decided that they didn't care so much about clean energy and climate change and all that. They cared about paranoia that there's going to be another Chernobyl in their own backyard and that they're all going to die from radiation sickness. So the Germans, the Angela Merkel, capitulated to all these anxious Germans and decided to shut down the nuclear energy sector. And of course, in the process, they decided, we need to burn coal and of course more natural gas. Yes, we need to become dependent on Russia and support Nord Stream 2 and enable Putin to play games with us and extort us into doing its will. So all that utility stockpile came into the market. But in the past year, the Sprott Uranium, Physical Uranium Trust, got revived, raised a lot of money, has been cleaning up the spot uranium and hoarding it, and the price is lifted into the $40 to $50 per pound range. That enabled a lot of these sort of uranium junior optionality plays to do very well in the last quarter of 2021. They have stalled right now because after going over $50 a pound, uranium is treated back into this sort of $40 to $44 a pound. It is sparking interest in uranium exploration juniors, especially ones in areas such as the Athabasca Basin where you can find these unconformity-associated high-grade deposits. as opposed to these lower grade roll front deposits that are typical in the United States. All the American owners of these deposits, they still have their facilities on standby. They're not going to start production because they need $60 plus uranium. But there is a whole cult of uranium followers out there, and anytime uranium does get a lift on the upside, you'll see an upwards movement in the uranium stocks, and of course in the opposite direction. It's become very similar to gold. It's almost like an ersatz gold. Whatever way the gold wind is blowing, that's the way the market's attitude is. Again, my view is look at the explorers. Look for intersections that show, hey, we have a new high-grade discovery, and now we are going to delineate. That's the sort of uranium junior that I'm particularly interested in at this stage.
Are you buying juniors now?
I think now is a very good time to buy the juniors. The hesitation people have is they're looking at the general equity markets. And we had a very rocky, volatile January, some major pullbacks, but then we saw it climb back again. The Dow continues to do hold in there. What happens when we see these interest rates start to rise and see the bond market sell off further? I'm not sure whether it will trigger a cascade of selling. So people who are aware of the resource juniors, which admittedly these days is a tiny fraction of the investing public, they are still living in fear. They had a brief period in 2020 between May and October when all of a sudden the resource juniors came alive. The biggest funding window opened up since the peak in 2010, 2011. Juniors got cashed up, but it was sort of a relatively small group of buyers, ones familiar with the sector, that put the money in, that own these things. But there hasn't been a narrative that has spread beyond the core, and the core doesn't really have a huge amount of extra money to put in. I think it's a great opportunity for newcomers who are willing to think about how does this sector work. If I'm tired of momentum gambling and there's no monster trends where I buy it in the morning and sell it in the afternoon and feel really smart about having caught the trend in the right direction, if they become interested in placing fundamental outcome bets for which they have to wait, because in the resource junior sector, it's all about actual developments, news release events. We accomplished this, we accomplished that. Oops, we didn't accomplish that. The results are poor. Down goes the stock. Understanding the game in terms of these time extended longer term bets and following these stories to see how they're evolving, whether there's any pleasant surprises or unpleasant surprises. That's sort of the game that the resource junior sector has to sell itself as to attract a bigger audience. And I went through all the little juniors at the end of last year and collected 150 to 200 of them I tagged as bottom fish juniors, ones with interesting rethink systems, money in the treasury, a lot of them missing some sort of piece such as marketing skills, some of them missing money but have a great story. And for me, this is a very fun period because I can sift through this. I can pick the ones where if I see the story, I can see how this can really attract an audience, either by them understanding the story or by this drill hole that they're doing. If it delivers what they think is there, I can see, doubling, tripling, and maybe most people will wait until this starts to happen. That's the nature of my bottom fishing concept. It's for sophisticated investors who can understand these stories, the potential, but also the missing pieces, and can judiciously place bets amongst these relatively cheap junior who have only modestly lifted off their bottoms from the end of last year. Yes, it's a period to be buying these resource junior bottom fish.
Do you have a list of the bottom fish picks you like at the moment?
Yeah, this is what I published at the end of last year. Actually, I published them through the last 2 months, I would tag them, and my subscribers would be able to go to a page and they would see what's there, and then they could, because Kaiser Research is a research platform with all these tools. A lot of my subscribers are do-it-yourselfers. They're not waiting for me to put a spotlight on a bottom fish and have it, suddenly go up. And okay, John, what good is that? You made it go up by pointing it out to everybody. Better to just discreetly tag them as such, have all your information and resources there. Let us do that final digging and accumulate it. And yes, if I have my position and you finally get around to doing a write-up to it and exposing it to everybody else, that's great. That's how we're running the Kaiser bottom fishing operation. Favorites are now free because it's a small group of companies that have graduated from the bottom fish workshop. Right, I expect as the Kaiser Watch Show proceeds this year, we will add more bottom fish to the favorite list as they get their act together, the missing pieces fall into place, and expose that to a broader audience. And hopefully out of that broader audience, I'll attract sophisticated investors as subscribers to Kaiser Research.
What are the key components you look for in potential bottom fish stocks?
The classic things are capital, people, structure, and story. Structure's not as important as it used to be. It simply means, is there enough stock concentrated in hands of management and other supporters who will help the company market itself, help it get financed, to give it a bigger audience. If the shares are all owned by the general public, management's probably not going to do very much. They have no incentive. They'll just live off whatever treasury is there. So I want to see at least some incentive that motivates management, and if they are just proxies, I want to see evidence that there's powerful people in the background who are constantly talking to these people. Capital, of course, it's money. A lot of money was raised in the second half of 2020 and also in 2021. And even in that last quarter, there was good fundraising. But the juniors suffered this plague of a 4-month hold period, and the money they're raising often comes from parties that are simply loaning the money to the company. As soon as it's free trading, they blow out the stock and just clip the warrant and have their 2-year to 5-year free ride on the whatever upside the company can muster. But the company still has the cash. They often end up cheaper. So I look for money in the treasury, and especially some sort of post-financing pullback towards this 4-month period. It used to be that when the 4-month period ended, you would expect a big promotion to be mounted. But right now in the current climate where there isn't a clear-cut narrative predicting, gold to $3,000 or copper to $10, that doesn't really work very much. But most importantly, I look for story. Is there an interesting story? And even more importantly, I look for the missing piece. Why is this stock cheap? Why is it being ignored? Is it something that's wrong with management that can be fixed? Is it some permit that they're waiting for? Is it just market skepticism or ignorance about the nature of the project? I look for this missing piece. And if I think that it can be fixed, then I become interested in that company as a bottom fish, because when that gets fixed, that's when these stocks deliver their 200, 300, 400% gains before they start doubling and tripling again.
These days, how do junior companies promote their stocks?
Right now, the most important thing is tell the market your story. And when the COVID pandemic hit, it really taught everybody how to do these Zoom interviews, to do webinar presentations. Before that, the small conferences like the Metals Investor Forum, companies would go there. They'd have 12 minutes or so to present their story. It wasn't enough time to make a detailed argument as to why you were a success. You were simply telling the basic story, what it is that you're trying to accomplish, what you're doing about it to hook the audience's attention and attract further follow-up, engagement between potential investors and the management and their investor relations department to figure out the story, get your head around it. And for a while there, when gold was roaring and the battery metals were roaring, some companies were promoting themselves by sponsoring websites which are fake sort of research outlets that you have to pay them in order for them to discover that they like the company and sing its virtues. And these typically have free audiences, so like they provide their services free. They make their money from the corporate side, either directly from the company through some sort of sponsorship deal or through intermediaries who are associated with the company who, are invisible. They're those insiders that don't show up, and they're the ones that provide the payment to these outfits. At the moment, with no momentum in the resource junior sector, that's not really working very well. So the best companies can do is just make their story very clear, have their corporate presentations up to date on their website, and even if it's something simple like changing the October 2021 date to February 2021 after making whatever changes to capital structure or so, and that tells the market that, hey, this document is good. The corporate presentation right now is the most important marketing vehicle for the companies. Websites are turning into a total mishmash of garbage. They don't have structure anymore. They've got all this sort of new wave type of stuff of things flashing in front of you. I find many of these newfangled websites absolutely useless to do research. Thankfully, there's still the CDR system where I can go and get the documents that the companies are required to file. So make your story articulate, keep your presentation up to date, and do those webinar things, do those interviews. People will take the 10, 15 minutes to sit there and get their head around the story. And once they own your stock, make sure you do these types of updates so that those people who own it can be reminded as to why they owned it and why they should continue to own it.
The junior miners encompass a number of different metals. Do the junior miners go through different cycles depending on whether they're into lithium or uranium or copper or gold or silver?
Although we had a 10-year-long bear market in the resource juniors, starting in 2011 when gold finally retreated from its uptrend, there have always been pockets of some sort of metal that captures the market's attention, whether it be lithium or cobalt. For a while, vanadium captured people's imagination. Gold, however, is the one that is most important in boosting market interest. But gold has suffered a bit of a body blow with the arrival of Bitcoin and the whole narrative that Bitcoin is the future for hedging against inflation and the new form of money. In reality, it's just a parasite on money because you buy and sell it in dollar terms. So and you sell your Bitcoin in order to buy things in the real world. So this whole Bitcoin thing is a bit of a delusion, but it has sucked up a lot of the gambling capital that used to go into the gold juniors as a proxy for the gold price trend. But I think the idea of like when rare earths went up 1,000 to 2,000% in 2010 to 2011, I mean, that was a classic example of a sector that nobody knew anything about, where when, for geopolitical reasons, China suddenly curtailed the supply, the price went to the moon, so visibly to the moon, and an obscure metal that was linked to stuff like the hybrids and the computers, all the little magnets that are in all these technologies. All of a sudden, that sparked enormous interest in companies that could get hold of a rare earth deposit. I'm not sure that some metal spiking crazily anymore. Palladium did that. It was almost $3,000 as a result of the Volkswagen diesel scandal. All of a sudden, platinum goes into the diesel cars, catalytic converters. Palladium goes into the gasoline catalytic converters. Suddenly everybody ditched their diesel cars and started buying gasoline-powered cars, and suddenly the relationship between platinum and palladium reversed, and there were only so and so many mines out there, and with palladium at that level, that was very interesting for resource juniors, because in South Africa, where the major reefs are controlled by big companies, platinum grade tends to be higher than the palladium grade, but elsewhere it is more balanced, or palladium grade is even higher. So that theoretically should have created a boom, and there was a collection of juniors that were able to raise money and end up with higher prices, but we did not see anything resembling a frenzy the way we did, say, with rare earths back in 2010-11. So yes, where the money flows and where people pay attention to what's happening to the metal in the macro term space is relevant, but it's not that important overall anymore. Only gold really still has the ability to ignite the whole market if it starts trending up in terms that make people believe, oh, this is not going to stop and retreat. This has a long way to go before it stabilizes.
Do you know if people have gotten rich from playing penny stocks?
The ones who have keep it very, very secret. So, no, I don't know any who have gotten rich playing penny stocks. And you use the word playing. Playing is like gambling. You go to the casino and you see if you can get lucky. Now, if you're going to play blackjack and you know how to count cards, then you can systematically make money. But they don't let you do that. They watch for people who actually are doing card counting, and they've made it a rule. You're not allowed to consistently make money at gambling. So they kick you out and won't let you gamble in their casinos. So most people, they're playing swings in the market. They're gambling on momentum. And some get lucky for a while. You look at, say, Cathie Wood with her ARC funds, and she caught the right upswing in sentiment about all these disruptive technologies, and caught the wave, and her high-risk exposure paid off handsomely. But all that is now coming undone as people shift their attention from super growth in a low-interest environment to a slower growth, more value-focused, boring type of environment. All of a sudden, her magic formula is no longer relevant, and that happens in the junior resource sector too. People who are gambling on what the uranium stocks will do, inevitably they gamble too long. They try and outsmart the market, but eventually the market outsmarts them, and they give back most of what they gained. In some cases, everything that they put into the market. Playing, I call it, where you make money is in finding stocks that are cheap, where there's something missing, taking a significant position and waiting for the company to fix itself. And the ones who do make a lot of money in these juniors are the ones who organize these companies, who buy the really cheap paper early on and put in motion all the machinery needed to fund the company and give it a public limelight that brings in new capital, so that the new buyers take the paper off the hand that they minted for themselves at a considerably lower price during the formative stages of that junior.
How can people follow you and your new show, Kaiser Watch?
Again, just go to KaiserResearch.com, look for the Kaiser Watch link, and also look for the KRO favorite section. The reports that are related to the favorites are unrestricted, so you can see kind of a glimpse of what's everything behind in this system that has over 2,000 companies in it. So KaiserResearch.com, go there. There'll be 2 dashboards. one for members only, and another one for the general public that isn't behind a paywall.
John, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been John Kaiser. Check out his show, Kaiser Watch, on his website, kaiserresearch.com. Coming up, Robert Campbell, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the realestatetiming.com newsletter. He's speaking to us from beautiful San Diego. Welcome back to This Week in Money, Bob.
Thank you very much, Jim. Happy to be with you.
Bob, what's going on with the U.S. economy?
U.S. economy right now is that based on what some rather reliable warning signals are, that we could be looking at a recession here coming down the road. And the key is, and why I say that, to give you a little bit of evidence, any time in the past 50 years that the Federal Reserve Board has started hiking interest rates, that has especially to stop inflation, that has resulted in a recession. And so that we're kind of anticipating that right now. That's a big thing right there. That the number one key for forecasting recessions, with almost a perfect track record, of course, is the inverted yield curve, where the 90-day versus the 10, where the 90-day is 90-day T-bills have a higher yield than the 10-year. And I guess we're about 50 basis points away from that, so we're not there yet. But also that you start to see when we have extremely negative interest rates right now. We have inflation at 7%, and the 10-year yield is about 1.6, 1.7 last I checked. And so it's negative by almost, over 5%. Anytime you start getting negative yields like that, just the way the world works, the economy starts slowing down and you go into a recession. So it looks like we have recession warning signs on the horizon right now. However, will we have a recession, regardless how strong the signs are? That's a very good question, because all the Federal Reserve has to do is step in and pump another $3 trillion into the economy, the first hint of a recession, and voila, no more recession, everybody. So, we can stop recession. Would we stop inflation? No, inflation would be much worse. So, but, it's like pick your poison.
Now, I remember the 2008 recession. The German solution was to give everybody $10,000 to buy a new car if it was made in Germany. Would that work in the United States if you bought a car that was made in the U.S.? And, of course, American-built cars are partly made in Canada and partly made in Mexico, so you actually pick up the entire North American economy. A year later, Germany was out of recession and everybody had a new set of wheels.
Well, that's an interesting. I hadn't heard about that, Jim, but, and really I'm not qualified to comment on whether that would work or not, but, a $10,000 car, giving them $10,000 to buy a car, I don't know how big the auto industry is here in the United States. What economic impact that would have. Now, the biggest industry in the United States is the real estate industry, the home building industry. Everything that's taken into account when you build a new home, that represents 15% of the economy. I don't know where a car would be. I'm sure it would be way, way lower than that, because a house costs, here in the States, close to $400,000 median price. And what's the average car nowadays? It's way less than that. So I'm not sure that would do it.
I was thinking, Bob, there's so many people now who can't afford rent or mortgages. They're living in their cars, so maybe you would be buying them a new home.
Wow. Let's not go down that road, Jim.
Yeah.
But you're absolutely right. One of my comments in a previous newsletter I made, that I wrote in my final words, I said, in the 1970s, which is when I graduated from college in 1969, if you worked hard, you could buy a house. And I'm talking about in California, Southern California, which was basically on par with the United States at that period of time before California real estate prices took off. But I could have bought a house near the coast in Southern California, maybe a mile from the beach, for $65,000. Today, anybody graduating from college, they have to get 2 jobs, as you say, Jim, just to afford the rent. So anybody that says things haven't changed dramatically, they have.
Oh yeah, precisely. When I graduated from high school and I started working in radio when I was in high school, you could buy a tray of draft beer for $2.
Hey, gas was 35 cents a gallon, Jim.
Right.
I always rode those hot rod muscle cars because that's when I grew up and was going to college. Big engines, little cars. The price of fuel didn't matter because it was 35 cents a gallon. UCLA tuition was $200 a quarter. Now, and I've got a degree in econ. For those of you that don't know me, for those that nowadays, an econ book for one of those classes costs $200. Tell me that's not screwed.
Yeah. And also younger people do have expenses that we didn't have. We didn't have cell phones or cable bills or internet bills to pay for, and our college loan didn't cost $100,000.
Jim, as I recall, I don't think anybody that I knew needed a loan to go to college. If you just did some low-grade task during the summer, that's what I did. I didn't have a low-grade task. I was working construction sites for my dad, and I always got paid 2 or 3 times as much as everybody else because it takes the skill to frame a house versus, pump gas at a gas station and clean windshields. So it was what they used to do then. But my parents paid half the money, and I paid half the money. There were no loans, and it wasn't even a struggle. It cost me $200 a quarter in tuition. I joined a fraternity, $400 a month. Room and board, Jim. Room and board. In other words, my hard costs for everything, we're probably, if you include my car and gas and insurance and all that, we're probably about $600 a month. I had no idea what it is nowadays, but it's so ridiculous. Most people need a big loan, need to borrow tons of money to get through college. And what's interesting about the economy right now? The last I checked, that there's still a moratorium on student loan payments. So we think everything's just hunky-dory, everything's clicking into high gear here, and we're getting back to normal. This economy is so weak. People they won't even, stop that rule that you don't have to make payments on your student loans anymore. And student loans in the United States represents a $1.4 trillion debt service. So we're talking a lot of money. So I'm really big, kind of segueing into, other things of the economy. I'm really starting to wonder that if we aren't going to, click into and stay in high gear inflation here for the next 5 years or 10 years, and everything's just going to go crazy, just like it did in the 70s. It didn't go crazy, but what things happened in the 70s, and here in the United States, from 1970 to 1980, inflation averaged 9% a year. Housing costs in the United States went up nominally 9% a year. So in other words, you didn't win anything or you didn't lose anything. Let's say, for example, that we get into that same situation today, where we're going to start seeing a new cycle of inflation, where it's not going to stay up like just go up 9, 10, 11, 12, all the way to wherever it stops. It does fluctuate. It goes up, then it backs off. If you look at our inflation rates going back to the 1970s, they first went up, and then they started going down, then they went up, then they started going down a little, then they went up again where they peaked in 1980. But if we see that same thing happen today, what you could see in real estate prices here in the United States, you could see housing prices double from where they are right now. Are they high? Yeah. They've never been this high anywhere close to this before. But if you start seeing inflation go off like the 1970s, and let's say we have a similar episode, you could see housing prices double on a nominal basis from current levels, which, of course, when adjusted for inflation, means they haven't gone up a bit. But nevertheless, everybody looks at the headline numbers. You know, my house in 2020 was worth $500,000, and in 10 years later, in 2030, it's worth $1 million. You know, it doubled in price. We could see that, and the sole reason is inflation. Sole reason. I mean, have the homes become more valuable? No, not at all. So why have they gone up in price? Because of currency devaluation, of inflation. So this is really fascinating right now, that, you know, what we're seeing on the inflation front. And, of course, the Fed thinks it's all transitory and blah, blah, blah. I'm not buying that for a second. You know, here in the stock market about, in the last month, the stock market took like a 10% dip because everybody thought the Fed was going to raise rates. And all of a sudden it's back up to close to all-time highs, has recovered, at least 50% of that loss that it took. It's near the high point again. What I think the markets are telling you is that the people that have money invested in the markets, which is the rich guys, of course, stock market, they're the only guys that own stock. They don't believe the Fed. They know the Fed's not going to raise rates because they can't afford to raise rates. Because the U.S. National debt hit $30 trillion, and if all of a sudden you start raising rates, right now debt servicing is 10% of all the U.S. budget. 10%. If you raise rates, from where they are right now, and I think the average coupon or something on all that $30 trillion of debt is, somewhere between around 3%, around 2%. So if all of a sudden that just doubled to 4%, which is nothing, which still wouldn't stop inflation, you'd see debt servicing double within a year or two. So, I mean, not only are we running $3 trillion deficits here in the States right now to keep the wheels on the car, now that would jump up, to $4 trillion. That's why I don't think they're going to do it, guys. That's why I don't think they're going to raise rates. I think we're just going to live with inflation like we did during the 1970s. And for most people, it's going to be devastating to them. Because the things that go up the most are food, energy, and housing. You cannot do without those. And like you say, Jim, maybe that's why a $70,000 new car makes sense, because it's a comfortable place to live, right?
Also, one of the government solutions to inflation was both Canada and the U.S. agreed back in the 90s to not include housing or fuel or the cost of taxes in the inflation index. Well, what a miracle. The next year, inflation was down dramatically. And that's how they got down to their 2% target. But ask anybody who buys groceries how much prices have gone up. And there's another little trick they've done at the grocery store now. The price of that coffee hasn't gone up, but the size of the package has gone down.
Right. All these little tricks. And they think they're fooling everybody. Talk to a housewife that goes shopping once a week. Ask her if food prices are up 5% last year, or if it's not like 25%. And I'll tell you something else. It's that how they've rejiggered the inflation formula. 40 years ago, 30 years ago, the medical costs that the average American budget was represented by about 5% for medical costs. Today, it's 20%. And in the CPI figures, Jim, the number they use for how they weigh medical costs, 7%. And is anything going up faster than inflation? Than medical costs? Not many things. And let me give you guys a real life example. I'm on Medicare. You have to be over 65 to be on Medicare, which I am. And they raised on our cost of living increases, called COLA. They raised our benefit for Social Security payments by 5.9% last year. What they take out of that for Medicare Part B, A is free, but B you have to pay for. The price of Medicare Part B that you have to pay for went up 28%. My prescription services that I pay for to have insurance against that comes out of my Social Security payment. That went up dramatically. And let's see, my supplemental insurance that covers what Medicare Part A and B don't cover went up dramatically. Net. After it's all said and done, they raised my Social Security benefit by 5.9%. But after taking out all the more expensive deductions for medicine, my net gain was $4, Jim. So if that's happening to me, that's happening to everybody. So I get $4 extra a month to cover everything else that's not included in medical costs. I mean, that's how people are going to get hurt.
Bob, I think the most important thing people need to get from our show today, I think, is how to prepare for this inflation and what can you do to protect yourself.
Okay, and those are great questions. The first thing you can do, the best defense against inflation, is to be good at what you do, guys. Be highly skilled at something. So that when the other people are losing their jobs because they're just average at what they do, you are so good at what you do, you'll be the guy that'll have the job. And you might even make a premium to what you made before because you need good people. That's the first thing you can do. Be really, really, really good at what you do. Secondly, you have to consider moving your assets into asset classes that will benefit from inflation and not get hurt. And during the 1970s here in the United States, the two best performing asset classes by far, by a mile, were commodities and gold. So that's where you should be reestablishing, putting your money. You should take it out of the stock market, even though the stock market has the best long-term inflation hedge during periods of high inflation, like in the 70s. The U.S. stock market lost, on an inflation-adjusted basis, lost 50% of its value. So right now, that's what you need to do. And, I have certainly changed my portfolio that, I own real estate and, a few other hedges like that. But also that my Roth IRA, that's represented right now 50% in commodities and 50% in gold. And I'm just going to stick with that position. I'm not going to trade it because that's where you're going to get the most bang for your buck. So you got to adjust, guys. So to recap, you got to be good at what you do, and you have to adjust your portfolio so that you're more likely to benefit from inflation and not get hurt by it. But what about real estate? Real estate, like I told you before, so we hit that big target. Real estate neither gained nor lost anything during the 1980s in the United States. It was a perfect hedge. So, if you have real estate, as long as you can afford to keep holding on to it, where all of a sudden you don't have to sell your real estate, to move down and lower your standard of living, that it should be a good inflation hedge. So you might hold on to it, but as far as actually outperforming, you need to be in commodities and gold. That's what the lessons of history and the last inflationary episode taught us in the United States.
What's going on with real estate in the U.S.? Are people worried you're going to see another housing crash like back in 2009?
No, not at all. Mm-hmm. You never see that fear at the peaks. And even though housing prices are extremely expensive right now, like they are in most parts of the world, like they are in Canada, like they are in Europe, like they are in Australia, the New Zealand, housing prices are going crazy for some reason. They're at all-time highs and accelerating higher. But what I'm thinking is, whether it was by luck or by design, people have flooded into real estate and overpaying because they expect inflation to take off, and it's a good hedge. It's a good long-term hedge. Plus, you have to live somewhere. Also, I read a report about 6 months ago, and it talked about people that had purchased real estate in the last 2 years in the United States, paid these high prices. A house isn't a maintenance-free item. It costs money, to maintain it and keep it up. 40% of the people that were able to qualify to buy a home in the last 2 years in the country are now have a second job in order to make ends meet. So in other words, this That is crazy. But you know that. I mean, all of a sudden, get something done on your house if something breaks. It's expensive nowadays. You know, not only with inflation, but with the shortages. So if this inflation holds at these high levels and continues for the next 5 or 10 years, I think that you could see that people say, oh yeah, that there was housing hasn't crashed. Well, that maybe it hasn't crashed nominally, but maybe it'll start crashing in real terms. Because the only time real estate really did poorly in the United States relative to inflation was in the 1980 and 1981 when inflation rose to 13%. 13.3%. Real estate did not do well. It did not rise 13%. It rose less than that. And that's why you see on a real basis, during periods of super high inflation, or double-digit inflation, I should say, real estate values are a poor inflation hedge.
What's happening with migration of people in the U.S.? Are people abandoning California and heading to Republican states?
Yes, in general they are. The migration is, more people have come across, illegals have come across our border than ever before. And the out-migration in the country, the states with the two highest out-migration are, number one is New York and number two is Canada. And where are they going? They're going to Florida, a red state. They're going to Texas. And, those are the only two states I know. I'm not sure what states are red and which states are blue anymore. So, but that's where they're going. They're migrating to those states, and the influx of people into the highest in-migration is in Florida, it's in Idaho, and it's into Montana. So people are getting out of the cities and off the coast, which is high density living, and in a lot of cases they're moving into the flyover states, which is low density population.
Now, you call them the flyover states, so the ones that have the contrails overhead, Iowa and Kansas.
All the flyover states are this. All that distance area between the East Coast of the United States and the West Coast, those are all flyover states. Because something like, some ridiculous percentage, Jim, something like 80% of the total population in the United States is located within about, the 20 miles of the coastline.
Yeah, and it's like most of the Canadian population is within 100 miles of the U.S. border.
Right.
Yeah.
Yeah.
Yeah, we all have our little favorite, maybe economic hotspots and so on. Now, if people are leaving California, does that mean California real estate is getting more affordable?
Nope. It doesn't. And that's what's really interesting. That's why I don't believe any of the statistics. Because, I've seen these statistics, and the U-Haul statistic is the most worthless indicator in the world. Like right now, to go from San Francisco to Dallas, Texas, to rent a 26-foot U-Haul truck, U-Haul claims it costs almost $6,000. To take that same U-Haul truck from Dallas into San Francisco, it costs $1,000. In other words, everybody's leaving San Francisco for Dallas. Nevertheless, are San Francisco real estate prices or crashing and Dallas are going up? No, not at all. So I don't know what to believe, Jim. I really don't know what. I just knew that mostly, if everybody was exiting California, the prices would come storming down. That's simple supply and demand. That's one economic principle that always works and never fails. And we're not seeing that. So all this, out-migration, in-migration stuff, the acid test is, are housing prices going up or down? And if housing prices are still going up, nobody's leaving the state, net. They're not. They're coming into the state net. Demand is increasing.
Bob, I know you like to give us a health tip to wrap up the show, so what's the big health tip today?
Today, the big health tip. Gosh, there's so many of them. What I think you got to do, guys. First, let me make a general comment about health that a lot of you have heard me say this before. It's the most important thing in your life. It should demand the highest priority. And I'm just not walking the walk. Talking the talk. I walk the walk. I've practiced, maintaining, the optimal health for the last 50 years. Because what it does, when you're in good shape and you're fit and you're healthy, one thing you feel good. and it gives you confidence, and that confidence shows, and you just feel better about everything that you do. It makes life more successful, and lifting weights not only works on your body, it works on your brain. So it helps that aspect of it. All of that. And what I found about getting in shape, guys, is this. The hardest part is just start. You've got to start. And I don't care, you say, I'm going to get in better shape. Great. Don't go to the gym saying, I'm going to go to the gym, every other day and work out for an hour and a half. That's not going to work. You're going to get hurt, I can almost promise you, and you're going to quit going to the gym, and that whole magnificent goal of yours is going to go down the toilet. So what you got to do is go to the gym and say, look, I'm going to start slowly. But every day, I'm going to go to the gym every other day for 30 minutes. I'm going to lift weights for 20 minutes. Then I'm going to go home. And you'll start feeling different. And plus, you got to eat right, guys. Diet's the hard part. You got to keep your weight off and lift weights. And I'm talking about guys now. I don't know about girls, what they have to do. So you just start slowly, and then the key to it all is consistency, guys. You just have to be consistent. I was walking out of the gym. I was in the gym about a month ago, and one of my homies came up to me and said, "How you doing, Bob?" He said, "Are you just about done?" And I said, "No." And he said, "How much longer?" And I said, "For the rest of my life." He looked at me and smiled and said, "Exactly. You just have to keep doing it." But I promise you, the benefits that you'll enjoy from getting in shape, eating right, feeling better about yourself, and everything that you do, you won't believe how good it'll make you feel. You won't believe it. And I tell you, it's not only getting fit, but then as you get older, what you have to start doing is you just can't let yourself get old. You have to constantly be reaching out. Reaching out. I made the decision this year, Jim, that in 2022, that I made the decision that I'm going to write another book. I wrote the book, Timing the Real Estate Market, you guys, self-published. I wrote it 20 years ago. It's still as accurate today as it was then. I've sold 31,000 copies of that book from my website, and I self-published it. When I published that book cost me today $3 to print up 1,000 copies, and I sell it for $39 or $35. Having that product, and I finally said, I have learned so much in the last 20 years. I need to share this with people. I have an obligation to people in this world, especially my followers, to do as good a job as I can, to direct them, correctly which way real estate prices are going to go. And plus, being good at what you do, you have an obligation to yourself, guys. You have an obligation to be as good as you can be, whatever you choose it is to be. I don't care what it is. You should make that pact with yourself. I'm going to be very, very good at this, and you'll always make a good living from that. So I decided I'm going to write a new book. I'm going to write a new book. Decided to do that, and also that I mentioned this before, but I'm still practicing to play in a over 65 fastball league, playing hardball, and for the first time in 40 years, that I hit off a pitching machine. It threw 40 miles an hour. It wasn't 60 foot 2 inches away from the plate. It was about half of that. But coming in at 40, if you haven't hit a live ball in 40 years, that was quite a challenge. But I couldn't believe it, how well I could still hit. So you got to start practicing. And my other goal is to be play hardball at age 65. I'll be 75. I'll be 75 years old in 3 months. And I said, those are the kind of things you do, guys. They keep you young. They keep you alive. They keep you interesting. And you know what they do? They give you a super amount of energy. They just energize you. You're empowered when you do those things. That you always got to be moving forward, guys. Always moving forward. Never stop. Never stop. You can stop when you're dead. Always be reaching out, trying to achieve little better things, what they are, something that are really a reach for you. And I promise you guys, that will make your life incredibly better. And one of my projects, I don't think I'll have time to do it this year, but I may do it next year. I'm going to write a 20 or 30 page report on everything I have done myself to get myself in the kind of shape, the kind of attitude, the financial position that I'm in, and I'm not a super rich guy. Am I comfortable financially? Yeah. And one of the ways to fight inflation is to have a job. I'm 75 years old, and I still publish a newsletter. One, I do it because I love it. Two, I do it because I'm good at it. And three, I do it because that's your best defense against hard times, is always have a reliable source of income that you can count on. Another thing, guys, look, if you can't count on yourself in this world, you're screwed. You have to be able to count on yourself. You have to be that confident and say, wow, if things get tough, I'm still confident I can get through it. And a lot of way to do that is that ever since I was a little kid, that, every dollar I made, I'd save 10 or 20 cents. So I have quite a pile of cash built up, and I've lived within my means. I live very comfortably. We live well, but I've lived within my means. That, I could go 5 years. I could lose all sources of income and go 5 years, and you wouldn't even know it. So, I call that, that's the kind of place that you want to be. And that's something that is achievable. You don't have to live for the day. And even live for the day. Fine, live for the day. There's a lot of cool things you can do. You don't need to be driving around in a $150,000 car with a $15,000 Rolex watch on your wrist to try to convince the world that you're a successful guy. Most of the successful guys I know that have a lot of dough, you wouldn't even know it. You wouldn't even know it. I know they have a lot of dough because they're my age. They're not spending it. Well, they spend it. They live well, but they're not conspicuous spenders. So, you got to get yourself in that position, guys, and you got to start young with that. I think that if I had to do things over for the world, I would teach a class at college, and it's called managing money, practical finance. I could teach you kids how to manage your money, things these college professors, they have no clue about because they've never been out in the real world. But how to do that, something that's has practical value to it, well, all of a sudden you say, okay, I want you to start saving 15 cents out of every dollar you make. Deal? Deal. Okay, now what do you do with it? Now you got to invest it properly. How do you learn how to invest it properly? Well, there's lots of choices. You can do this, this, and this. Those are all good systems. Do one of them and do it for the rest of your life, and you'll be fine. And then take care of your body so that that you're physically fit, so you have the energy and the enthusiasm to say that I want to live to be 100 years old because I know that every year that this year was better than last year, and next year is going to be better than this year. And a lot of that, you guys, I'm not kidding you. It depends on how well you take. It's how healthy you are, how you feel about yourself, how you feel about yourself. If you're in good shape, if you're strong, if you can still hit a baseball 290 feet and you're 75 years old, you know what? That's honest to God proof. You're doing something right that most people don't do right, because you don't have to let yourself get old. We're all going to die for sure, but you'd rather go out like a shooting star than all of a sudden die in a wheelchair somewhere because you got diabetes or some other crazy disease that was entirely avoidable if you had taken the proper precautions when you were younger. And so and I talk like that, you guys, that even though it may sound like I'm trying to motivate you, what I'm really trying to do is I remotivate myself every single day. Every single day you got to say, wow, I'm not going to let anything get in my way. And do I have setbacks? Sure, we all have setbacks. And as far as working out, do I miss workouts? Yes. In the last 50 years, my rule's been never miss 2 days in a row. You can miss. Don't be that hardcore. And sometimes you get the flu. I had the flu once in my life. I couldn't work out for 2 weeks. That's an exception. But it has to be that determination that you're going to be the best version of you that you can be. And the only person you're in competition with, you guys, is you. Don't hold yourself out against something else. I'm not comparing myself against Elon Musk. No, I'm comparing myself against me. If I can get a little better, every year, I'm a big, big success. And that's all it takes to live a real, happy, and comfortable life. You don't need $50 million in the bank to be happy. You don't even need anything close than that. You need money so that you're comfortable, of course. And that unfortunately takes more than most people have, but that's the way the world works, I guess. But to give yourself all these advantages in life by doing this, by doing that, and it all starts, it's like building a house. I'm I come from the building industry. I was born on a building site. That's why I know so much about it. But a building, what's the most important part of building a home? It's the foundation. Absolutely. You can't build a great home on a crappy foundation. And the same with living your life. What's the most important aspect of being successful in life? It's being healthy. It's being fit and being healthy. Because the chances of you being successful financially when you're fit and healthy are infinitely better than if you're not fit and healthy. And like a friend of mine always says, you can take a 65-year-old rich man in poor health and ask him how much of his money would he give you to be in great health. He'd go, every single dime, all of it. So it's that important, you guys. I'm saying, and you got to start and you got to stay with it. It's like breathing. It should be that important. I drag my ass to the gym every other day to lift weights. And why do I have to go to the gym to lift weights? It's because us guys, as we get older, we lose our muscle mass. And what makes you look good, what makes you look young and feel young, is you have muscles. And there's no way around it. You got to lift weights to get those. You got to lift weights. And there's certain type of exercises I do. I just got back from the gym today. I do 6 different exercises. And it just keeps my muscles really strong and well-defined. And you look good. And when you look good, you feel good. And when you feel good, life is better. You're happier. You're more likely to be successful. So that's your foundation, guys. That's what I would focus on first. Because if you don't get that right, the chances of you getting, you may make a lot of money, but if you're in crappy health, you are not going to be happy. You are not going to be happy. And that's what it's all about.
Bob, where can people get your newsletter?
Okay, you can go to my website, everybody, at realestatetiming.com. Realestatetiming.com, just like it sounds, no dots or dashes, and it tells you what I do. You can buy my book if you wish, Timing the Real Estate Market. You can read a sample issue of my timing letter. But what I do is I time a total of, I think it's like 25 major housing markets in the United States. And as far as what I do, I've been doing this for a long time. I not only have the life experience, but I have the academic experience going back, and I consider myself to be the best real estate timer in the United States. In the world, maybe. And I work hard at it. So all it does, that's just an extra edge you have in life, guys. You're fit, you're healthy, you're not going to buy high and sell low, you're more likely to do the opposite. And if you just do those simple things in life, you'd be amazed at what you can achieve and how happy you can be and the type of people that are attracted to you. So realestatetiming.com, check it out.
Bob, thank you so much for being on This Week in Money.
Thank you, Jim. Talk to you later. Bye.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Kaiser, and Robert Campbell. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry, and happy Lunar New Year's.
Yes, well, a happy Lunar New Year's to you, Jim, and I'm glad to be back.
Year of the Tiger. So did you kick off the Year of the Tiger with a news release?
Yes, we had a news release out on the February the 2nd, and it was to do with the patent allowance in China. And I did get some feedback on that. They felt that now the Chinese would know how to utilize our process, but the reality is when we filed our first patents and they were approved in the U.S., they were printed. And so So this is just extra protection. Like the guy said in that newsletter that I sent out from Seeking Alpha, that it was building a moat of patent protection. That's what we were doing, and that's exactly what we were doing. And I'd sooner have a patent in China than not have one. We've already got the patents in South Korea, Japan, and India. And we're waiting for 2 allowances to come through, the Chinese and the Canadian, and then we've got the Australian, and the European. So it's a great day for us, and nothing to worry about there. That's just further protection. And we still feel that we've got it by the. I was going to say something rude, but I won't. We've got it by the
tail.
Hey?
Yeah, you got the tiger by the tail.
Well, that's it. You're the tiger by the tail.
Now, Larry, this patent protection, what is it protecting?
It protects our IP, intellectual property. It protects our process, which is part of the intellectual property. It protects our, our know-how and how we do it, and our science. So it's really important for a company to have these. Only those companies that don't have patents will poo-poo them. But I'd sooner have a patent than some proprietary knowledge, because that's more difficult to prove. And away you go, Jim. It's the patent protection is very important. There's nothing for the shareholders to worry about. The more we have, the better the protection we have. And it's just a company being prudent with the shareholders' money to make sure that we're not taking steps in the wrong way. We've pretty much built this whole company on getting those patents as the first number one crucial results from our R&D. And after that, it's been improvements on the R&D. As I've said in many broadcasts, that the sands are always shifting. And speaking of shifting, Jim, the lithium market has been going bananas. It's up 4 times. It's around $54,000 a ton in China now. So it's critical. If you don't have production like China does, production and chemical processing of the lithium, then or the rest of the cathode materials and anodes, then you're not going to be protected. So we like that lithium price. It shows that we have a number of about $18,000 a ton on a ton of scrap. So $18,000 a ton, that was about the total number that we had with the all the cathode materials and lithium back a year ago. So all the materials that are used in building batteries are going up, even aluminum, which is up about 50%. And so we also reclaim aluminum. The price of the lithium going up the way it has would certainly turn the dynamics on lithium iron oxide, or so it's just a big plus for us. And but you can't really build a company on spurts in the market. You've got to look at the overall market, and you've got to decide that hey, this is a fairly safe entry point. This is where we can make money, and then you go into negotiations, and this is one of your focal points. If you don't know how much money you're going to make, how can you negotiate a contract with somebody? So we try to get keep our horses in front of the cart, and the cart will catch up. But these are exciting times in the market. I think we closed at 85 or 86 today, So, it's been a steady go and steady buying in the market. So, I couldn't be happier about that. So, Jim, we're going to go into the weekend here with a couple of great things. One is the sparking lithium prices, also the uplift in the other cathode material prices, and certainly the patent applications. So being accepted. So it's been a good week. It's been a good week. My health is beginning to get better, and I certainly wouldn't wish this on my worst enemy. It's a combined illness of like that can really put you on your back for a while, and it takes a while to build back the energy. So you can't overdo it. And that's something I've learned, something I never learned before. I was off last time I had pneumonia. I was off for 3 days, and that's not enough. That's not enough to recuperate. So I just advise everybody to look after their health, because that becomes the dominant thing in your life when you don't have it. And so let's just continue on, Jim. I wish the shareholders a great weekend, and looking forward to next week. And I also wish yourself and Tom a great weekend, and Kim, I should say, the neck that turns ahead. So it's been a good time, Jim.
Larry, for people who are new to American Manganese, what's the company all about?
Well, it's a critical metals company that we got involved in technology back in 2008. That's a long time ago now, and it was to take low grades of manganese and be able to produce them, something the U.S. Bureau of Mines was not able to do in 60 years of research. But, in their defense, I have to say that there's been new developments in filtration and things like that that have made it easier for us to develop a process that can take very low grades of manganese and turn them into metal. And that metal fetches a premium on the market. So, we've taken that technology, and certainly Cameco recognized that this may work on the cathode materials in a lithium-ion battery, and sure enough, it did. And we're pretty confident that we've got the world by the tail, or the tiger by the tail, and we're going to keep moving ahead with what we've got. It's been a very slow, step-by-step process, but it's all coming together. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the QB board under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. We're very transparent about everything we do, so you can do your research on our site by just going to the site, looking at the press releases, looking at the qualifications that we have, and the endorsements that we have, and do your due diligence that way. It's you can reach us at, or you can get that site at AmericanManganeseInc.com. You can phone here at 778-574-4444, or you can send me an email at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on February 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.